In case you haven't heard of the 4% rule before, I have you covered. In brief, the 4% rule refers to the percentage rate you could withdraw from a retirement portfolio without running out of money over your retirement life. This was based on the Trinity Study, which has some limitation, which I have covered in further details in these videos. You can watch them either by clicking on the link here or find them in the video description below. Now, the problem with the 4% rule is that there's no consensus on whether it's a good rule or not. I made my argument last time that this is simply a rule of thumb and needs to be treated as such. What would be a safe withdrawal rate for you depends on your circumstances, your portfolio allocation, and your target. To nail this point further, consider this. The Trinity study behind the 4% rule was based on a 30-year retirement period, a 75% allocation of wealth in stocks, and 25% allocation in bonds. They did vary these parameters a bit, but in essence that's what they focused on. For stocks in particular, they chose the S&P 500. They also used data from 1926 to 1995. So right there you can see there are many parameters which don't apply in your case necessarily. So for example, if you have a 100% equity portfolio allocation in a globally diversified index fund and looking to retire early, you cannot simply apply the 4% rule. This could be very dangerous for your portfolio. Instead, what you'd need is to rerun the Trinity model using these new parameters, and obviously that's a little time consuming to do. However, I built a tool to replicate the Trinity study, which I shall describe briefly. The tool uses Yahoo Finance's publicly available API to gather historical data. In this case, I retrieved the data for the S&P 500. Initial runs showed there was missing data, and unfortunately I couldn't use any data prior to 1982. So the dataset is between 1982 to 2021, which is a lot smaller than the 1926 to 1995 in the initial study. So for the 30-year period, the Trinity study used 41 samples compared to my 10 samples, but at least it includes more recent data. If we take a 30-year retirement period with withdrawals made at the beginning of the year, that means we have 10 valid samples, each showing a 30-year retirement period. Here's what a 100% allocation to the S&P 500 would look like over 30 years, starting from 1982. Now you can see this also includes data from 1950 onwards, but as mentioned earlier, this data is incomplete, seen here clearly. So let me disable those results before drawing any conclusion, and now we're left with a better and clearer picture. So what you're looking at here is the performance of a £1 million investment portfolio in the S&P 500 with a 4% withdrawal rate. That is, every year you can withdraw £40,000. Based on this, you can see that in all cases you'd end up with more money than you started with. In the best case, you'd end up with 8 million, and in the worst case, you'd end up with 5 million. The others are pretty much in between. Sounds good, right? Well, hold on a minute. If we zoom back out, you'll see the dips which represent recessions. They don't line up in these lines because the 30-year samples have different start dates, but using the number of dates in the x-axis, you can sort of identify the major recessions. Remember, a year has approximately 250 trading days, so you're not looking at 365 multiples here. For example, you can deduce that this peak represents the market high before the dot-com bubble crash, while the next peak was the high before the 2008 financial crisis, both of which had huge negative impacts on the portfolio. In fact, you can see those two major recessions in the other samples as well, although they will be shifted. But what I really want to draw your attention to is the 1990s sample, which in 2008 would have reduced the portfolio almost back to its original value. The sequence of withdrawals along with the market condition made it the worst performer of all the samples. However, it recovered nicely after and ended up with a 5 million value. But that just goes to show that recessions can really put a dent in your portfolio. If the withdrawal rate were higher, then this would have been the end for this portfolio. Now what you saw was at 4%, the famous 4% rule. Let's look at withdrawal rates of 6, 8 and even 10%. Now with the 10% withdrawal rate, no surprise, things look pretty catastrophic. 6 out of the 10 samples failed and went negative. Of the remainder, 3 portfolios had some value but were less than the original portfolio value, so the portfolio went down. The only case that returned more than the initial portfolio was the 1982 sample, so it's clear that 10% is not a good idea. But here's where I was a little surprised. I was expecting a bleak picture for the 8% withdrawal rate as well, but actually all the portfolio were viable at the end of the period and only one fell below the initial investment value. This is slightly surprising to me, especially how 2% makes such a difference. It reminds me of the video I made about how just £1 can destroy your finances. Let's be careful here and remember we're not saying that 8% is a safe withdrawal rate, as this would have to be extensively tested rather than something rather simplistic here. Going down to 6% shows a marked improvement, and you'll be leaving your heirs quite some money, but still not terrible. Okay, so we'd look at the S&P 500 here. Let's take something a bit less diversified and riskier like the Nasdaq 100. With the Nasdaq 100, we had 7 samples, and those returns were simply spectacular. I mean, look at that 1 million, even with a 4% withdrawal rate, you'd end up with an astounding 60 million. With returns like those, would 10% withdrawal rate look as catastrophic as we saw previously with the S&P 500? No, although you'd have lost £30 million compared to a 4% withdrawal. But hang on, isn't the Nasdaq 100 riskier? Absolutely, but the returns are also spectacular, such that if you were to strip away half of its value, it'd still be a lot. So the common misconception here is that portfolio success is all about risk, when in fact it's only half of the equation. The other half, of course, is returns. What you need to understand is how much risk you're taking and for how much return. I explained this concept in depth through my previous video about portfolio optimization. Link is also in the description. So remember when I mentioned earlier there's a confusing message on YouTube as to whether 4% is too much or too little? Well, from what we saw above, it's highly dependent on what you invest in. So with Ben Felix's video, he was referring to a more diversified global portfolio with lower expected future returns than one would expect from historical S&P 500 performance. If a fund returns is lower, obviously the safe withdrawal rate will be lower, and logically the conclusion that would follow is 4% may be too high. This may be particularly true if you factor forecasts for equity growth, which are more pessimistic compared to the growth we've had so far. But Graham Stephan's stance on the other end isn't quite wrong either, because he was assuming that this historical performance of the S&P 500 would continue, and as we saw, the recent performances can easily sustain 4% and even 6%. In short, they are both right because they both have different assumptions. Which assumption eventually turns out to be correct is a bit of a mystery because that involves predicting the future. But that said, I do think Ben's approach is the safer option. Let's have a quick recap of what we've seen so far. The 4% rule was derived from a series of simulations under specific circumstances. You cannot simply apply the 4% rule to any retirement portfolio. Using a somewhat similar but more recent sample, I was able to show that the 4% rule would still result in a 100% success rate. However, this is assuming that future returns and volatility is as good or better than they have been in the past. To state the obvious, what you invest in is more important because, as we've seen, a higher growth portfolio will sustain a higher withdrawal rate. If you want to pick a fixed withdrawal percentage, then it's best to stress test the portfolio against ideally more than historical data through Monte Carlo simulation, for example. Or even better, adopt an adaptive strategy where your withdrawal is tailored to your goals and your portfolio status. Finally, the timing of withdrawals is important. Getting your timing wrong can have a negative impact on your portfolio. And it's something I'll cover in more details in my next video, so make sure you subscribe for more content and remember to like the video if you enjoyed it. Thanks for watching and see you next time.